Hello everyone, welcome to the very first webinar of the year. Happy New Year to everyone, first of all. Wish you all the best. Hopefully that will be a much better year than 2022 for everyone, a calmer at least. So yeah, so we will start our year with a topic that is not really something it's a bit rare. I mean, it's not easy to identify divergence. But before I go through on how to spot divergence, I need to make a bit of introduction and explain what divergence in trading is. So until I do that, as usual, I need to make sure that you can hear me loud and clear. So please stick on the question box whether you can hear me. Also, I have uploaded the PDF version of this webinar, so feel free to download it. It's in the handout section. And actually, until I have any feedback, I'm gonna go through as usual the disclaimer warning. Okay, so this material is provided to general marketing communication for information purposes only and does not constitute any independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as Forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. You can find all our risk disclosure, or full risk disclosure, in our website, hfm.com. Please feel free to check the website. You can find all the documents, legal documents that you might need. So I don't have any response. Guys, I would really appreciate to let me know and to let me know whether you can hear me. Okay, someone, yes, we can. Thank you very much. So we're good to go then. Here is the email address as usual. Oops, go back here. Webinars@hfm.com. Okay, so where's my pointer? Laser. Here, webinars@hfm.com. Okay, so here you can contact us asking for anything, any question that you have, something that you don't understand, not necessarily had to do with the particular webinar, but in general for trading. We are here to help, as I usually say. So, and I'll skip my introduction. So what we're going to cover today. Today it's all about trading with divergence, and you cannot see that. Why is not the case? Okay, perfect. Okay, perfect. So as I was saying, today we're gonna cover something that happens in the markets, the so-called divergence. So we're gonna see what it is, if we spot it, how we could figure out whether it's a bullish divergence or the bearish divergence, how we can trade using divergence. We have many examples in this slide, so I think it would be straightforward as soon as we see the examples. it will be pretty easy for you to comprehend today's webinar. And the something that is not very easy to be spotted is the hidden divergence. So we're gonna see also this section as well, along with an example. So first of all, let's do a bit of a vocabulary, okay, before we go to the introduction of divergence, just to make sure that we are all on the same page here on what is an oscillator, what do we mean by say momentum, divergence, negative divergence, positive divergence. So as is everyone a trader, by the way, guys, or is it someone that just started, hasn't traded, that is not, is a newbie? We have a newbie here. Anyone? 1 month and still new? Yes, you are. Okay. First of all, by oscillator, we mean any tool, any indicator that we use, okay, that oscillates or moves up or moves down along with the price of the asset. So if you have, even if you have a demo account, I guess you have a demo account there then, so you can see that we have a navigator over here with many indicators, oscillators, etc. So oscillator is any technical tool that we have, any technical indicator that we have that oscillates. So MACD, for example, that oscillates, it moves up and down, okay, based on the performance of the price, okay. Momentum, what we mean, let's go back, what do we mean by saying momentum? Momentum is is how fast or slow the price of a particular asset moves. So if price is moving fast over a particular period of time, we say that momentum is strong. If price moves slowly, then we say that the momentum is low. So there is not a lot of strength, a lot of push, a lot of bias to move the price. Okay? Divergence now. So divergence, an indicator moving in different direction to the price. So first of all, what is divergence? Okay, divergence, okay, is when, you know, if you notice right here in my, okay, if you notice, I will make a bit this clearer. Okay, over here on the bottom I have two indicators, right? Let me get rid of all this. Let me simplify. Okay, so we have two indicators over here, MACD and RSI, but that's the list, no problem. So divergence is when the price moves in a different direction than the indicator. So for example, if we are seeing the price moving up, but our indicator is moving down, which is not the case in this particular example. We're going to see more examples anyway. Then we said that, oh, we might have spotted the divergence. So it's pretty much is when the indicators are moving, an indicator is moving in a different direction to the price. Okay, just have this like as a not a standard rule, it's actually the definition of it. Divergence is when the price of an asset is moving in a different, opposite direction of the technical indicator that you're using. It doesn't have to be MACD like the one that I just showed you. It might be the technical indicator that you prefer, the technical oscillator that you prefer. So if you have a price, if you have spotted that the price of the asset is moving in a different direction than the technical oscillator that you're using, then this is called divergence. So what divergence does, why it's important? It's important because it warns you that the current price trend, okay, may in the future, in the near future, may be weakening. And in some cases, it may lead to a price changing direction. So let me simplify that. It pretty much gives you an alert that, you know what, maybe this trend is running out of steam. So maybe you will see sooner or later a reversal of the trend. Okay? Okay. So we have two types of divergence. Interrupt me if there is something that you don't understand. Okay, and we don't have a lot of slides today, so we can take it a bit slower. So we have two types of okay, I should say three because we mentioned hidden divergence as well. But let's start with the basics. We have positive divergence and we have negative divergence. So positive divergence is when the indicator moves higher, the oscillator moves higher, while the price moves lower. And the negative indicator in the negative divergence is the vice versa. But I will just move on because I have examples. So let's check them together. Yes, this is okay. Nicholas, I've seen your comment. That's why I've brought this. I have examples in the next slides, so don't worry. So let's check first negative divergence. Okay, as I said, negative divergence is when our oscillator, okay, is moving. Sorry. Negative divergence is when it signals that a move lower in the asset is possible. So a move lower, the negative divergence pretty much signals a potential reversal, a potential pullback. So for having a pullback, it means that our asset was in an uptrend or it was rising, right? In order to believe that we might see a potential move lower. So negative divergence is when our price moves up, while the oscillator is presenting something different. It's presenting the, please, can't hear you properly, but it catching up my my headset. So maybe it's your end, Rashida. Rashida, if you can hear me, please check your side because everyone else can hear me loud and clear. Right, guys? I can see that it captures, it takes the. Okay, so as I was saying, negative divergence is the divergence which signals that a move lower in the asset is possible. So and how it can be spotted? It can be spotted if our price makes a higher high, while the oscillator that we're using, it might be RSI, it might be MACD, it might be Stochastics, it might be, I cannot think of something else right now. So it goes on the other side, it posts low, it moves lower, or it posts lower highs, like the example, what I have put on over here as an example. So the actual asset posts some higher highs. Can you see the peaks? The peak A, the peak B, the peak 2. It moves higher, but oscillators started to fade, started to post some lower highs. So they have different directions. So that's a negative divergence signal, alerting that this uptrend might run out of steam and you might see a move lower sooner or later. Okay, so it alerts you to spot some support and resistance levels in order that could trigger that could confirm that the uptrend has ended and a downtrend has started. Okay, so you can see that point B and C in the oscillator is presenting, which are highs. These are the peaks. It presents lower high. LH, I'm referring to lower high. Okay, are we good so far? While on the opposite scenario, if we spot a positive divergence, is when our asset is either in a downtrend or it keeps posting lower lows, okay, like B, C, A, B, C over here, but the oscillator is moving in the exact contradictory direction by posting higher lows. Okay, so have you seen that we're using trend lines to connect the bottoms, the bottoms, and see where they're pointing? So positive divergence indicates a move higher, a potential move higher in the price. So it's a bullish signal pretty much, but that's just a signal for the time being. You need to combine it with some confirmed breakouts of the resistance in order to help you figuring out when the new uptrend has started. Okay, so this is just a signal. This is something that you will put a note on and say, I have spotted a potential positive divergence in, I don't know, dollar yen. So you put it as a note and you monitoring it. I don't know, in the daily basis. Depends what kind of trader you are, whether you're gonna keep monitoring during the day or just early in the morning. Depends on what kind of trader you are and what kind of period of time frame you're trading. So it's not, just to clarify something, divergence is not a call for entry, okay? It's just a signal that helps you, that gives you a hint that might, in the near future or in the long future, who knows, depends on the time frame, as I said, you might see your asset reversing. Okay, it's just a signal that occurs between the price of the asset and the technical tools that you're using. Okay, so it's not something that calls for action. It doesn't provide a trade signal. So let's move on. Okay, I will check my. Okay, there are no questions, so I will keep moving. Okay. I think I missed the slide. Sorry. Perfect. Here we are. Yeah, this I have already mentioned that, as I said, is not an entry signal. Okay, it's a particular sign that the asset that you are monitoring might reverse. So it's a possible trend reversal ahead of time. So your entry will be once you actually confirm that the trend has reversed. Okay, so it's just a sign ahead of time. It's not an entry. So it alerts you to search for support and resistance entries that will be used in the future as your possible entry points, exit points, and etc. What else? So first, there are some rules or some steps, if you prefer, that it would be ideal for you to follow in order to make sure that you have read the charts properly, or with the best possible way. So you need, first of all, to identify where your market is going to, where the direction of your market is your ass in an uptrend, is your ass in a downtrend, is it in a ranging market? Because if it's in a ranging market, then then diversion is of the scenario, right? If it's ranging, then it's ranging. It's just bouncing between two barriers. So the very first thing that you need to spot is the direction of the market. Secondly, once you figure out whether it's going up or down, when it posts some higher highs or higher lows, or uptrend or downtrend, you can you can check your oscillators, the one that you use, not necessarily stochastic or MACD, depends on your preferences. You need to check the direction of your indicator and compare them. If they are the outcomes are opposite, then that indicates divergence. If they are not opposite, they are on the same direction, that means just a continuation of the trend. It is not a divergence, okay? What else? Yeah, caution. That's my very last bullet point. Sometimes you might spot a divergence, right? But it might never happen, okay? Or reversal might already occurred. It doesn't mean that it will definitely happen, okay? That's why we said it's not a call for entry. It's just an indication, which then it calls you to identify support and resistance levels in order to, in the future, to help you spot whether a new trend has started. Okay? Okay so far, guys. Shall I move on? Okay, yep, okay. Okay, before I go, I move on to the next slide that it has more examples and explanation in regards to the bearish divergence. Okay. Actually, no. That would be my recap. Yes, I will not keep passing you with the. Okay, let's move on. Okay, bearish divergence. This is a real example. It's not just a presentation that I had previously. It's a screenshot directly from my MT4 for pound Swiss. Okay, it's a daily chart because it was easy for me to. It was the one that I spotted. The time frame is not. I mean, something fixed. If you're a day trader, okay, fair enough. You're checking the daily time frames in order to see where your asset is, in which direction your asset is moving, and where your oscillators are moving. But if you are more of an intraday trader, that's fair enough. You just if you spot the divergence on the time frame that you're trading, that's fair enough. Okay. So over here, I noticed that while my pound, so ignore this bit, okay? For now, actually, I will zoom in just to hide it, because I want to show you, first of all, what I noticed before when I noticed the divergence initially. So the pound Swiss was moving in an uptrend, right? Okay, I put a trend line, I connected the latest highs, and I put a trend line on. But in general, you can see that is clearly in an uptrend with some short swings lower, but posting higher highs and higher lows. So clear uptrend, right? At some point, however, by connecting the peaks of the MACD, we notice that the MACD is weakening. So the peaks are lower and lower. It's posting MACD oscillator, sorry, stochastic oscillator is posting lower highs. So the direction of the asset by putting the trend line on, it was pointing higher, while the direction of stochastic by connecting the peaks with this trend line, it was pointing lower. So what is this? Do you remember what we called that earlier? Anyone? Yes, yes, bravo, Shin. Negative divergence, or otherwise bearish divergence. Negative, bearish, the same thing. So price action makes higher highs, indicator makes lower highs. So what that means, that this is a warning that, you know what, maybe in the future, near future, or it might take a while, or it might never happen, but it might revert downwards. So this uptrend might run out of steam soonish. So, as I said, this is not a call to action, but so it's not a call to action. So we need to do some homework. We need to spot support levels, because if our support levels are triggered breaking, that could be our possible entry. So possible entry can be taken once trend line breaks downwards. So what you can do in this case is, do I have a line on? Can I put a line on? It's either put some vertical lines on the support and resistance levels. So where it's my, so once you spot that, okay, one support level is this one, this bottom. Another potential support is this one, because it was a previous low and a previous high. So that's another support, potential support level. Or a different way to do it, depends. Many of you might have different ways to might have different tools to um, um, to spot their support and resistance levels. Okay, it doesn't matter. I'm just showing you, just to understand. Or by connecting the lows. Okay, let me stop. Okay, I cannot do a straight line. Okay, sorry for that. So I have the upper trend line by connecting the highs, and the lower trend lines by connecting the bottom. And if, as soon as I see the price breaking this line and moving below it, extending southwards, that could be a possible entry to the downside. And if I just continue, we'll see that it finally break it over here, but quickly reverse higher again, and then finally kept extending lower and lower, and that any of these candles or this breakout, the 50-day moving average over here, could have been another possible entry. So it depends from you guys, what, as I said, what kind of trader you are, what kind of strategy you're following. Okay, so I cannot really say, oh, you need to do that, you need to enter there, you need to enter there, you need to enter there. Each one of you has different uses a different strategy, trading strategy, entry points, exit points, and etc. Okay. So, and indeed, divergence, it was a really good signal, because you see, it moved as low as 149.80. So indeed, a reversal that lasted for more than a month happened. So that was indeed a nice divergence signal, well spotted. Okay. So this is a bearish divergence. Also, you see, if you have spotted that your moving average, in this example is a 50-day moving average, this blue line, it used to support very, very well your asset, then this could be a breakout of the 50-day moving average. In this case, it was also a possible entry point, okay? So let's move on. Yes, okay. Again, divergence can be used only for giving clues of a new trend. It does not indicate when you should enter the market or a possible stop level or a target level. You need to use your trading strategy in order to spot your potential entry, exit level, target, and etc. Okay. Some possible entry points is the ones that I show you, but that solely depends on your strategies, guys. Okay, your I don't know, preferences and etc. So now let's do let's say bullish divergence example. So as I said, it's the vice versa. We have seen that earlier. Positive divergence, or otherwise known as bullish divergence, is the signal, the indication, let's say, that when the price goes, sorry, is the indication that we might see soonish a bounce of our asset to the upside. Um, yeah, an upwards move from our price asset, from our asset. Sorry. So, in order for a bullish divergence to be occurred, we need to see the price moving on the opposite direction than the oscillator. So that means the price could start the price is moving lower, right? But our technical oscillator is moving higher or showing bullish signals. So that is a possible positive or bullish divergence, which signals that we could see the price moving higher soon. Okay, so that's another example. That's a dollar CAD daily. So it was in a downtrend, and that's pretty clear. It's a bit sharp decline as well, as you can see, which was lower, a bit of a reversal, but still lower high, and again another sharp sell-off. So in a downtrend, you can connect the lows, you can connect the highs, and on the flip side, stochastic, RSI as well, by the way, but stochastic, the one that I have put on, we could post that it posted a higher low. Can you see that was lower than the next one? Okay, and the next one was even higher than the previous one. So it started pointing to a potential, pointing slightly higher. Okay, in contrast with the price, but we are not sure, right? We saw it, we spotted, we put a note on, and in order to be ready if this scenario indeed takes place. Let's move on. So that was is the same asset, is dollar CAD. Okay, we have spotted the divergence, the potential, the possible divergence in the daily chart. So remember that before I said that another way to identify a possible entry is either by identify support and resistance levels, right? In this case, it should be resistance levels. So the previous highs can be used, right? Or in this case, the 20 and 50-day moving average, or different way to confirm that first of all, indeed the divergence, the bullish divergence took place, and to spot your entry is by going to a shorter time frame in order to figure out possible entry levels. So let me, first of all, we have, other than the previous highs, right, the previous fractals, etc., that can be used as immediate support and resistance levels, we have also the moving averages, right? So 200, 20, and 50, okay, could be used as, they are resistance levels, which if they are triggered and broken, that could call for entry. But if you have noticed the appreciation of the asset, and you are more of a scalper or an intraday trader in general, you can go down to shorter time frames, okay, and having a possible entry for a short period of time, obviously, because we're in 1 hour chart, every time that the asset is breaking is breaking the range, or is breaking your trend line. So what I mean, let's take it step by step, okay? So over here we have a nice bounce, right? Nice bounce, some intraday strong bullish candles, okay? But we have noticed a bit of a range over here, right? You see, sideways, sideways, sideways. So by connecting the bottoms and the lows, you can see that the asset is ranging. So the breakout either to the downside or to the upside of that range. So as if we get a confirmation that the asset exited the range, then that will be a possible entry. Or, like I previously showed, connecting the highs and the lows, right, with the trend line, that will help you also to spot a potential entry. So over here, it was in a decline, posting lower highs, lower lows. So by connecting with the trend line, the peak, the highs, as soon as the asset breaks your trend line, so moves above it, like here, that could be a possible entry. Okay, so because you remember, we have spotted in the daily chart, okay, let me tell you, we have spotted in the daily chart a bullish divergence. So what that means, that from a downside, we're going to have an uptrend. Okay, so these are entries in which will allow you to finally participate on this, on this reversal, right? Are you with me? Yes, this is Francis. This is recorded. So as soon as we end the session, I sent the recording to the team, and they forwarded to you via email. Okay. So this is recorded. Yes, as usual. So even if you missed this rebound, even if you missed that, you see, if you go to shorter time frame, you can spot more possible entries that could allow you to participate in this medium term daily uptrend, let's say. Okay. And oops. Okay. Okay. Let's now check. We mentioned, I think we covered. Thank you very much, Kerio. We have more actually slides. So, okay, let's touch a bit the concept of hidden divergence. Okay, what we mean by oops, no, sorry. Sorry, let me just correct. Come on. Okay, hidden divergence. This is where we are. Sorry, just a second. Okay, what we mean by hidden divergence. Okay, so hidden divergence is when, so we said that divergence is an indication of a possible trend reversal ahead of time. Now, hidden divergence is an indication of a possible trend continuation ahead of time. So it gives you a sign that, you know what, your uptrend will continue for longer, or your downtrend will continue for longer. Okay, so continuation ahead of time. But again, even in this case, it's just it's just an indication ahead of time. It's not a certain sign that you can that calls you for action. So again, it is the same concept. You need to spot other trigger points that that they will confirm you that yes, the trend will continue. So I can either add on my existing position or enter on the direction of the trend. So it's not a certain sign. Is an indication that the market might continue in the same direction. So what you need to do next is to search for your support and resistance levels, because that would be, as we said, your possible entry in the same direction of the trend, since the trend has further to run. So how you can spot it? It's a similar with a similar way. In this case, the hidden divergence can be spotted once indicator movement does not goes along with the price action of the instrument over a period of time. So what would you need to do first? Firstly, identify the direction of your asset, right? The direction of your asset. Secondly, check your oscillators, okay? Remember, opposite outcomes indicates divergence, right? But what we mean by how we can spot whether it's a hidden divergence. So let's move on to the next slide. Oops. Here we are. So look at that. Look at that. Okay, I will put also, I connect the highs as well. Oops, that's awful. Let me clear this mess. Okay, okay. Let me try again and do a line. Oh God, okay, that's awful. Okay, okay, okay. This is very, very sensitive. What I mean, the hidden divergence is quite difficult to be spotted. Why? Okay, I will take you a bit back, just to remember that we said that for identifying, okay, let's go to the bearish scenario. For identify the negative divergence, a bearish divergence, we connect the highs of the price, right? You remember that? The highs of the price in order to show us that it goes up, and the highs of the oscillator. Now, in the hidden divergence, we need to check the bottoms, right? So we don't only connect the highs, we connect also the lows. And the same stands for the oscillator. So over here, if I check for divergence for using the highs, I can see that the highs of the price show up but the oscillator is a bit flat. By connecting the highs, I have a bit flat. It's flat. If I could have done a straight line, you can see that it was flat. Now, since this doesn't indicate divergence, it means I don't have divergence. Let's also check the bottoms just to make sure that we have or we don't have a divergence. So if I connect the bottom, again, it shows up. So we are clearly an uptrend. But if I connect the bottom of the oscillator, it shows down. So this is what we called hidden divergence. It's not the classic divergence in which we have higher higher price, higher peaks, higher highs, but lower highs for oscillator. It's a bit different. We cross-checking the, if we are okay. It's a bit confusing. It's a bit of confusing. So that's why I'm gonna add something that I didn't have before. It's a nice picture that clarifies the differences between the classic divergence and the hidden divergence. So let me just give me a second to add it on the slideshow so you will be able to see it as well. What slide is that? Is the very first for hidden divergences and that one? Yeah. So I will duplicate that. Perfect. Come on, delete, 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 delete. I will add this. Perfect. Okay, I just added the screenshot. This is the differences, okay? That will help you a lot because this is the regular, the ones that we have saw before. This is the hidden. So if you, okay, what we are just seeing is that version. If you're in an uptrend or your asset in general is posting some higher lows, but your oscillator is posting lower lows, that's a bullish hidden divergence. Okay, so it's the scenario that we were just it's the example that we were just seeing. If your asset is in an uptrend or in general does some higher lows, but the lows of the oscillator are lower low. So 1, 2, 3, 4 within the same period, right? That is a bullish hidden divergence. So what that indicates that our uptrend is still strong and it will continue to move on the same direction. But what we need for that, we need a confirmation because this is not an entry for call, it's not a call for entry, it's just an indication. So what we need to see in order to either add on our existing condition, the position, or to open an uptrend and a long position is to check our support and resistance level. So in this case, it's resistance level because it signals a potential continuation of the uptrend. So we need to see some either a breakout of the immediate resistance or I don't know, breakout of the previous highs, or I don't know, maybe you're using your ATR. It's up to you. So this is an hourly chart, by the way. This is just to show you that divergence exists everywhere. Doesn't necessarily need to be daily. So I will take my pen again, and Okay, we have spot that, so we need to do our homework, right? So I can see that we have resistance over here and in this range over here. This is our immediate resistance level. So ahead of time. So as soon as it breaks this range, I could enter long. Indeed, it break it over here. So that was a nice possible entry. Or if you missed that, okay, at the closure of this candle, that one, you could enter still long because it signal the continuation of the uptrend. You can say, but Andrea, this looks very, I mean, it doesn't move a lot. Yeah, but it doesn't move a lot. Okay, it's one hour chart, but indeed keeps posting higher highs. So if you have entered here, you could have benefit around, so from 144, 145, let's say, 30 pips. That's not bad. I mean, don't be greedy. So another, since that was an hourly chart, another way, as we said, is to go to a shorter time frame. So what's the next shorter time frame after 1 hour? Is 30 minutes. So go down to your 30 minutes. You have already, in the 1 hour, you have already put these lines. I mean, by saying this line, I'm referring to the trend lines that we have spotted our hidden bullish divergence, and the barriers, I mean where we started it from and where it ended it for. Okay, we have these lines on. So when we go to the 30 minutes chart, okay, we need to start searching for possible for resistance levels. So as I said, the very first one was our previous high. Indeed, broken here. So that was a possible entry. You might have missed it. You might weren't on your PC that time. You might were, well, I don't know. You might missed it. You will spot your next possible entry, right? So, okay, we have a repeatable high here. We have a repeatable high here. So that would be another entry. That would be another entry. This one here, because it break it and it quickly turned down, tried to break it again, didn't manage, and started moving down. So that previous high could be a possible future entry if the asset breaks above it. And see for how long it was moving up, until 101.48. You couldn't see that in my 1 hour chart, but here it was when we, I said, let's say when we spot the divergence, it was around 144, 145. Look here, 147.70, right? Are you with me? Everything okay? So you do some homework, because doing this homework will help you. As I said, it doesn't necessarily mean that will happen, but if it does, it will allow you nice beforehand, ahead of time entries. Okay, it's a very powerful indication. That's why it's so difficult to be spotted. But once it's spotted, once you see it, put a note. Another example, but a bearish one. Over here I have pound yen daily. It was quite difficult to find an intraday one, but yeah. Okay, example A, example B. Let's spot the first one. Example A. Down, higher and lower highs, right? And by connecting my highs again, so if you're gonna connect the highs in the price, you need to connect the highs in the indicator. If you're going to connect the lows in the price, you need to connect the lows in the indicator as well. I mean, okay, so remember the slide that I showed you earlier. Okay, you're gonna have it, you're gonna comprehend that, you need to study that, but here it is. Highs, so lower highs, higher highs, so opposite direction, so bearish hidden divergence. Okay, You know, an easy way to remember it is that um, in a bearish scenario, regular one or hidden one, you should connect always the highs to the price in the indicator. In a bullish scenario, either regular or hidden one, we'll always connect the bottoms. Okay. Where are we? Bearish hidden divergence. So connecting the highs, oops, I connected the highs and I saw that it's moving down. Nice, clear. So since I connected the highs in my price, because over here you cannot connect the lows. It's not a repeatable. Never mind. Okay, ignore that. Don't want to confuse you for the time being. Let's take it one by one. Okay, connect the highs. Connected the highs of my oscillator as well, and it was pointing up. So that's connecting the highs. Connecting the highs. That means continuation. Bearish hidden divergence means further to the downside. So a continuation of the downside. So what do you do in this case, as we said? You can find your immediate floors, right? In this case, is this one, and say that if it breaks it, I'm gonna enter short. So it break it here. If you missed that, okay, you didn't saw that, all this, you didn't saw that. You participated, you were monitoring the pound yen, I don't know, in the mid of March. So you missed all this. But you spotted that. You spotted that it continues posting lower highs, okay, lower highs, while your MACD is posting higher highs, up. You see, oh, what's going on over here? Indeed, it was doing signal indicating a bearish hidden divergence since November 2025 up to February 26, and it keeps doing that between 2026, beginning of 2026 until March, April, whenever you have entered this, you monitor this chart, let's say, and you're saying, oh, it's keep doing that, it's keep pointing to further detection. Okay, so what I will do, since bearish hidden divergence says that our downturn will continue, right? So what we need to spot immediate support levels in order to participate to this continuation of the downtrend, right? So whereas it's our immediate floors. If we saw it in March or if we saw it in February here, then our immediate floors is this one and this one, right? So that could be possible entries. And here it is. It's the same example, but I'm showing you what happened afterwards. Remember, I put a trend line at 15640 and at 151. 15640, 15640. I think it was that one, isn't it? It was that one. And at 151 and that one. Look at that beauty. Look how much you could have benefited if you put your potential entries over here. If you were afraid to put it at the immediate one, then at 151, look how sharp the sell-off was. How much further it detected. 151 up to 130. That's 2000. No, what I'm saying. Oh my God, is what? Let me do the maths. I'm curious right now. Oh my God, that's 2,000 pips. That's 2,000 pips is insane. Okay, it's a long-term position. I mean, it's a daily chart, and it took a long time. It took another 2 months. So it was a position for 2 months. It's for long-term traders or medium-term traders, but still. Okay, you could have taken it. You could have, if you are intraday trader, still you can benefit because you know you have figured out these support levels. You go to a 4-hour chart, 1-hour chart, and once they break it and move lower, then you could you could open some short-term short position. Okay, let's recap. Okay. I'm gonna call the session over here. You will see that we are just on the 20th out of 32 slides, but all the remaining slides are just further and further and further examples, but without using MACD or stochastic. I'm using RSI and MACD, or it's just more and more examples. It's just for you to study them, to see more and more and more examples. It might be old ones, it doesn't matter, just to show you the mentality, the concept, okay? So it's just more and more and more examples. And in regards to limitations that we're seeing over here, uh, it's just if you are in a very short time frame, this is 1 hour. When we say 60, it's at 1 hour. That you need to be faster, obviously. Okay. So more and more examples. So if you face any problem with them, if there is anything that you don't understand, send me a screenshot and send it to me via email at webinars@hfm.com. Okay. So let's recap. Same as divergence. Here, divergence is just an indication that the price might continue the same direction. Must always be combined with your trading strategy. You don't have to follow me and say, okay, Andrea said that I could use the previous lows or the previous highs as my support and resistance level, or I could use fractals, or I could use trend lines for spotting support and resistance level. You don't have to stick on what I just mentioned. That's one way of doing it. You have a different exit or entry strategy, or you have a different way to spot your support and resistance levels. You might be a person that use pivots and you use low support and resistance levels. Fair enough. Fair enough. You might be a person that uses Fibonacci's in order to spot its support and resistance level. You might be a person that uses, I don't know, Ichimoku. You don't have to be blinded and stick on what I just mentioned. That's use your own trading strategies to spot your support and resistance levels and combine it with the concept of divergence. Okay, there's nothing wrong with that. Each one of us is different. We have different preferences. We prefer to trade in different time frames with a different way, with different tools and etc. That's fair enough. Divergence, either the classic one, either the hidden one, does not indicate when you should enter the market, or a possible stop loss or a target level. It's just an indication. Use your trading strategy to spot your entry, your stop, your target. Sometimes, if you prefer, that's up to you. You can go in the next shorter time frame, not too short. I mean, if you're in 1 hour, you cannot go to 1 minute to find your entry point. No, you will go to the next one. So if you're in 1 hour, if you have spotted the divergence in the 1 hour chart, you will go to the 30 minutes chart to spot an entry. No more than that. If you are in the 4 hour, you have spotted the divergence in the 4 hours chart, go down to the 1 hour to spot your entry point. If you're in a daily chart, you have spotted divergence, you can either do your usual trading strategy in order to have an entry, or you can go down to the previous time frame, so 4 hour in this case, to spot a an entry point, a possible entry point. The higher the time frame, the more reliable hidden divergence alerts might be. So what we mean by that, like in the daily example that I show you, the higher time frames, because it's a bit slower environment, if we spot a divergence, it tends to be more reliable than a divergence that we spotted in a really, really fast environment, such as the 5-minute chart, 15-minute chart, or 30-minute chart, okay? But yeah, it's just for you to be aware that you need to be extra careful, okay? In short time frame, risk for the trend to be completed before traders spot the hidden divergence is possible. So be extra careful, monitor, check whether the trend is already completed. Using another indicator, if you prefer, yeah, just make sure that the momentum hasn't faded. And that's pretty much it, guys. The next slides, as I said, are more and more examples, which we completed the hour, so I don't want to waste more time. Check them. I think I've put, I've put a lot actually. So take your time, study them, and if there is anything that you don't understand, come back to me at webinars@hfm.com and tell me, Andrea, this slide says that and that, I don't understand. Please explain, okay? So be careful. There is no divergence if the market is ranging, right? Obviously. Yeah, that's pretty much it. Thank you very much. There are no further questions. I'm gonna call it a date. Thank you for your interest, and as I said, anything you need, I'm here to help. Enjoy the rest of the day. I would like to remind you that this very first week of the year, we have an FP on Friday. So the very first NFP of the year. That's actually the highlight of the year, of the week, just for your own information. And this is our brand new mobile application. Thank you very much, and see you again tomorrow. We're gonna have a live analysis. I think Stuart is doing it this week. So live in either go to webinar, Facebook, YouTube, LinkedIn, Twitter. So feel free to join us and ask for any asset you want or for anything you want in general. Thank you. Have a great day ahead. See you. Bye-bye.